Hi, okay, welcome back. Now we're going to discuss something called lump sum purchases. So very often a company may buy, instead of one machine at a time or one piece of furniture at a time, several items for a group price that they've negotiated. And that's called a lump sum purchase or a basket purchase. However, each individual asset in that purchase needs to be recorded separately. You need to debit each asset separately for their price. So if you paid one price for several assets, how much do you debit each asset for? So we are going to use what's called the relative market value method to calculate this. Okay, here's an example. Smart Touch Learning paid $100,000 on August 1, 2019 for the land and building. An appraisal indicates the land's market value is $30,000 and the building's market value is $90,000. So two assets, a building and land, they're paying $100,000 for both, even though if you took their individual values, that would add up to $120,000. So how do I split that $100,000? I add up their market values, $120,000, okay? And then I'm going to say out of that $100,000, they're saying the land is worth $30,000. So 30 out of $120,000, if I do the division, 30,000 divided by 120, I get 25%. So land is represented as 25% of the purchase. What about building? Building is 90,000 out of 120. Now these are market values, keep in mind, these are the market values. 90 out of 120 is the remaining 75. So those percentages I'm going to apply to the actual purchase price of 1,000 to come up with the cost. So here's the math. We did this already. We did up to here already. So from the left up to these percentages. Now I'm going to take those percentages and multiply them by our purchase price. This is how much I am going to assign to each of the assets. So if I look at my entry, I debit land for $25,000, which was 25% times $100,000, and I debit building for 75% times $100,000, and the amount I owe on a note is $100,000. So that's how you handle a lump sum payment, or lump sum purchase rather. There is also an important distinction we need to know between capital and revenue expenditures. All right, I already spoke to you about the term capitalization. So when we add to an asset's cost, we are capitalizing those costs. Anytime, once we own the asset, if we make it better, if it's going to live longer, or if it's going to perform better, any money we spend to like put a new motor in that's better than the old motor, or the latest technology upgrades, whatever that is, that will add to the life of the asset, and we are going to debit the asset to increase its value, and that's called a capital expenditure. Okay. If we do something, well, down here it's mentioning extraordinary repairs. So again, those are very big, huge, substantial expenditures, but the asset's going to last longer. The asset's going to work better. Those items will become capitalized. So what's not capitalized? If we're just maintaining, if we're spending money to have a tune-up done on a machine, or to have extra oil, or to grease up a machine, or whatever it is, lubricate a machine, that's normal maintenance, right? To fix the wires on the machine, just like your car. Changing the oil, changing all the fluids, things like that is normal maintenance that we can expect to have to perform on certain assets. Those normal practices are not capitalized. They are expensed, and we call them revenue expenditures. So we don't add them to the asset. We immediately expense them as maintenance expense or repairs expense, and they're immediately expensed from income in that fiscal year. Oops. So as an example, spending $3,000 to rebuild the engine on a 5-year-old truck is an extraordinary repair because it extends the asset's life past normal expected life. That means we're going to capitalize it. How do we do that? We debit the truck. So the truck is already on our books, but by debiting it for $3,000, we're adding to that cost. We're adding to the value it is listed on our financial statements with. we are crediting cash for $3,000. Okay, that's capital expenditure. What if we paid $500 cash to replace the tires on the truck? Something you do every so often. You need to do just to keep the truck working properly. It is not making, extending the useful life of the truck or increasing its efficiency. I know some students will argue that, but it is a normal routine maintenance practice. So instead of debiting the asset, now we're debiting repair and maintenance expense, $500, and crediting cash. All right, they give you on Exhibit 9.3, please look through this, they give you examples of what might be capitalized over here on the left, where you debit the asset account, and what might be expensed. So familiarize yourself with those items. All right, so now we're going to get into there's several methods we can choose to depreciate our assets every year. All right, you see them here, straight line, units of production, and double declining balance methods. We're going to go through them with examples and explain to you each one. When you're asked a question, they will provide you with the instructions which method you should use to do your calculations. I think I'm going to end this video here, and we'll start with straight line on the next video.